The financial markets have been really interesting recently, and one of the things that I've found most interesting and entertaining has been this back and forth between two groups of people. On one side, you have the established traders and investors who have been making a fortune for many years with huge client bases, and they're annoyed that there's these newcomers to the market who they claim don't know what they're doing, they're gambling, they're driving up prices, and it's unsustainable. And then on the other hand, you have this new group of traders who think that that group over there are just envious because they're making huge returns right now and these guys aren't. And this is the new generation, the new way of doing things, and this is what's making money. But I think that's the beauty of the market. There are many different ways to be successful, and you can have two completely opposed views both making money because they're looking at completely different things and anticipating different movements in the price over different time horizons. Benjamin Graham, the father of value investing, is said to have stated that in the short run, the market is a voting machine, but in the long run, it is a weighing machine. This means that in the short term, the price of a company may be dictated by its popularity in the market, but over the long term, the price is more likely to fall in line with the actual value of the company. The difference between the voting machine and the weighing machine also dictates how investors should be planning their own investing strategy. And that's absolutely fine. It's up to you what aspects you want to focus on that you think is going to lead to the price moving in one direction or the other. You can focus on the long-term value of a company, the short-term movements based on the psychology of investors, whatever you want, as long as it works. The problem comes though, when people think they're focusing on one thing, in most cases they think they're focusing on the long-term weighing machine, when actually they're becoming obsessed with the short-term voting machine. And a lot of this confusion can be down to what share price movements and the market capitalization of a company is actually showing us about that company. Market capitalization, often shortened to market cap or markup, is the most common method for measuring the size of a public company. It's very easy to calculate. You simply multiply the stock price by the number of outstanding shares. In other words, it's the company's market value, and it's therefore dictated mainly by market dynamics. As the share price of a company moves, so does its market cap. Some investors look at huge changes in the market cap and think it means that the prospects or performance of the business have changed in proportion to that. However, this doesn't necessarily mean that anything has actually changed with the company. Take, for example, Apple. It was recently hitting headlines after an analyst claimed it will be the first company to reach a market cap of $2 trillion over the next 4 years. This is based on improving earnings per share, increasing gross margins, and generally improved services. In other words, the estimated market cap is based on the market being a weighing machine and correctly valuing the business, at least according to the analyst estimates. Now that sounds quite sensible, doesn't it? But it's not unheard of for companies to see a huge rise in share price just based on its popularity increasing among investors, the so-called voting machine. Now we've seen that recently with companies like Hertz, which filed for bankruptcy before gaining popularity and seeing its share price surging. And it does tend to happen with small cap companies, companies with low market capitalization. But that doesn't mean it can't happen with huge companies that are worth billions of dollars. Let's take a look, for example, at Nvidia, a speculator favorite. Up until 2016, the company had experienced a steady increase in market cap, and at $14 billion in 2016, you might think that was quite impressive. But wait. Just 4 years later, in 2020, Nvidia's market cap has reached a spectacular $221 billion. You know, just a casual 1,478% increase in 4 years. The company's stock price had tripled in 2016, and 2017 was another epic year for them as they knocked revenue and earnings estimates out of the park. But it wasn't all plain sailing. 2018 started well, but they weren't immune to the global economy, and as global growth began to slow down, they got hit hard in a tech stock sell-off. The market cap had reached $171 billion before collapsing to $78 billion by December. Nvidia was also a prominent company in the cryptocurrency space, and when the 2018 decline happened, this led to a slowdown in sales and inventory beginning to build up. Although they missed expectations in their financial results, they were still looking pretty good. They got back on track in 2019, which then continued into 2020, with market cap reaching that impressive figure of $221 billion by mid-May 2020. Of course, with the business improving fundamentally, it's clear that part of this rise is thanks to the market being a weighing machine. But with such a high valuation compared to earnings, it's clear the price is being driven up thanks to the market voting machine buying into the story of Nvidia's future potential. And of course, this dynamic between the market voting machine and the market weighing machine can cause the opposite effect for companies as well, where they start off rising in share price because they're super popular before the weighing machine takes over and the share price starts heading down in a bit of a tailspin. When Groupon went public in 2011, it was the biggest IPO by an internet company since Google. On its first day of trading, investors went wild and the stock price soared more than 50%. Not long after its IPO, it had a market cap of over $30 billion. But just a year later, in 2012, it had lost 80% of its market value. The voting machine had spoken and the weighing machine took over. And you know, sometimes these dramatic short-term movements in the share price and the market cap of the company can happen due to something other than the popularity of that company, something other than the voting machine, sort of like a malfunctioning voting machine. In 2008, as the global financial system was in crisis, Volkswagen went through this situation as it became host to one of the biggest short squeezes in history and briefly became the world's largest company at the time. Investors were heavily short on the stock, in other words, looking to profit from declines in the share price, as the outlook was pretty bearish. But a completely unexpected announcement by Porsche, claiming it now owned a 74% stake in the company, caught these short sellers off guard. Porsche began taking over operations at VW, and these investors were scrambling to liquidate their short positions. When this happens, it's known as a short squeeze, as investors who are short the company have to buy back the shares to cancel out their position. This drove the stock price up by more than 93%, making it the biggest company in the world by market cap on that day, worth $420 billion. It wasn't all sunshine and rainbows for Porsche though, as 2 days later, the share price had halved as the short squeeze loosened, and after a few short months, the price had returned back to normal. So I think the key takeaways from all of this is that it's okay if you want to trade or invest short term or long term. The important thing is to understand your place in the market and what it is you're basing your decisions on. So if you know you're basing your decisions on the long term weighing machine, that's fine. Just don't get sort of carried away with FOMO, fear of missing out, if you see the short-term voting machine driving up the price of something. Know what it is that you're valuing, know what it is that you're waiting for, and stick with that. And if you know that you are basing your investment decisions on the long-term weighing machine, then a good place to start with valuing the companies is with their financial statements. We recently put out a video where we're talking you through how to start reading these financial statements. So if you're not sure how to go about doing that and you've been getting carried away with the short-term voting machine, then click the video on screen now and get started with understanding how to break those down. If you like this video, please do hit the thumbs up button. Don't forget to subscribe to the channel and switch on notifications so you don't miss out on any of our future videos. And thank you so much for watching. I'll see you in the next one.